Today I want to discuss the concept of control in corporate consolidation and how it has evolved under Australia accounting standards. Control is a crucial element in determining which entities are included in a group's financial statements, directly impacting shareholders, management, and employees. Before 2005, under ASB 127, control was primarily defined by ownership. Holding more than 50% of voting rights was the key indicator. While this approach was straightforward, it lacked flexibility to address complex structures, like special purpose entities or contractual control. In 2005, with the adoption of Australian IFRS, ASB 10 redefined control. It shifted from a rules-based approach to a principle-based one. Control now considers power over the investee, exposure to variable returns, ability to influence returns through power. This framework moves the focus from ownership percentage to the substance of relationships. For instance, under ASB 127, a parent company holding 49% might not consolidate an entity, even if it exercised de facto control. However, under ASB 10, such influence would likely lead to consolidation, as the emphasis is placed on actual control rather than legal ownership. The evolution from ASB 127 to ASB 10 represent a shift from an ownership-focused model to a broader substance-over-form perspective. This transaction not only improves financial reporting but also more accurately reflects today's complex business environments. Next, Sienna will talk about the preferred control concept.
Our group prefers the new approach, which is the International Financial Reporting Standards, the IFRS approach. The control of the consolidation is significantly impacting the market stability and can also affect the regulatories. In this case, the IFRS is a better way than the GAAP approach. From the government perspective, as Australia relies more on the export economies, the IFRS approach, which is more globally recognized, may attract more the foreign investment and improve the Australia economic development. It can also improve the economic stability, and control plays a part in identifying risks and preventing economic crisis. The consolidated financial statements are more accurate for liability and risks and allow the Australian government to monitor and intervene to keep the financial stability. From the tax authority perspective, they can more easily tax the corporate entities to minimize the tax avoidance behaviors and ensure the taxes are paid when the economic activities happen. In this case, it increases the economic transparency and makes sure the actual controlled entities are consolidated. And it can also reduce the chance of the companies committing fraud and ensure a transparent financial statement.
Now I'll be sharing about part 3. ASB 127 focused mainly on voting rights and ownership to exert control in the investee. Although it did allow control existence when the parent entity holds less than 50% of voting power through contractual agreements. However, this is not comprehensive enough, as there will be special circumstances such as de facto control and special purpose entities. Under ASB 127, the concept of de facto control was not clearly defined, allowing a parent entity to avoid consolidating a subsidiary if no explicit agreements were in place. Whereas under ASB 10, investors hold significantly more voting rights and the other shareholding were widely dispersed, then the investor has power over investee. There are also legal loopholes when companies create special purpose entities under ASB 127. Special purpose entities are created by companies to manage liabilities and isolate risk. However, it lacks traditional voting structure, as its parent's control is based on contracts, not ownership. Therefore, it might fall outside of the scope of consolidation. One example is James Hardie, a manufacturer of asbestos-based building products in Australia. It faced massive legal claims due to asbestos-related diseases in the 1990s. Therefore, it created a special purpose entity known as Medical Research and Compensation Foundation, MRCF, and it then moved all over its asbestos liabilities into MRCF. It argued that MRCF is independent and not consolidated. Therefore, the consolidated financial statements that was presented to the public was material and incomplete. Potential negative consequences that may arise is that investors are misled about the entity's true financial health and make poor investment decisions. Shareholders lose money when share price plummeted. Creditors lend money to the company but end up not getting repaid, and employees lose their jobs and pensions. Now I'll be passing the time to Chris.
Understanding the differences between IFRS and US GAAP start with the concept of control, which is fundamental to consolidation. While both frameworks define control, they apply it differently. IFRS as a principles-based framework takes a broad power-to-direct approach, requiring the following three key elements on the slide. Its focus on substance over legal form allows for more flexible application. In contrast, US GAAP follows a rules-based controlling financial interest model, typically requiring majority voting rights. It applies the following two consolidation models on the slide. These differences impact the scope of consolidation between the two standards. When analyzing a corporate group's financial statements, key differences in consolidation between US GAAP and IFRS standards become evident. For investors, it is crucial to recognize that these differences vary by company and industry, significantly impacting financial presentation. For example, ASML, a dual-listed semiconductor company that prepares financial statements under both standards, highlights two major recurring differences: capitalization of product development costs and accounting for income taxes. The key differences are highlighted on the slide. For a broader perspective, investors must recognize the nuances between IFRS and US GAAP when making financial decisions. One key example is the adjustment for intragroup sales of inventory. This can result in higher reported cost of goods sold and lower inventory balance under US GAAP, potentially affecting earnings and asset valuations. Investors should be cautious when comparing revenues and profits across companies using different inventory methods. Given the complexity of accounting standards, it is impossible to cover every aspect in detail. However, it is the responsibility of investees to exercise diligence in navigating these standards, ensuring compliance and transparency. Likewise, investors must conduct thorough research, identifying key financial aspects that may impact their decisions. This is our reference list.